All right, great. Welcome, everybody. And thank you, David, for having me on board. These are always actually very interesting. Even if you've been in the business many years, there's always something more to learn. And in fact, just heard the prior presenter, Tim, mentioned a few books and made a few points and comments that I might also address here in just a few minutes. So kind of interesting how a lot of us end up with the same mindset, starting from different places and hopefully end up in a same winning spot, that is. But what we're going to do today is we're going to have a sneak peek, a preview of a much larger presentation. We're going to really dive much deeper, and we're going to show you how to get registered for that one here towards the end of our presentation. But we're going to talk about using automation, how you can remove emotions and trade options like a professional, looking at more of the professional option strategies, not just the well, we'll get into it here in just a second, but the way to make that happen is to automate your discipline using technology and algos, and we can use time management as well with what we're talking about in terms of not having to watch your screen all day and babysit your trades. And then we're going to look at strategies that can be applied to any market condition. And then we have really, quite frankly, these are amazing trade alerts. They're one-touch responsive trade alerts. I mean, we're going to show you a little bit about that as well. But again, this is just a preview of much bigger things to come. But before we get started, just a quick risk disclosure here. Remember, we're always talking about speculating and making money, and that means there's always risk when you're trying to profit. Just like the Duke brothers there are talking to Valentine about how they make money trading commodities. So keep that in mind as you read this risk disclosure, that there's always risk involved when you're trying to profit. I'll give you just a moment to look at that. Remember that all funds committed should be risk capital, and past performance is never a guarantee of future results. A little bit about us. We are AltaVest. Since 1997, we've been trading as an introducing brokerage firm. That's yours truly there with some of our colleagues down on the trading floor, the S&P 500 options trading pits in Chicago. Those were some of our floor staff there filling options orders for us. So we've traded tens and tens of millions of contracts over the years as a brokerage. A little bit about myself. I am Erik Gebhard. Been doing this 32 years. I co-founded AltaVest. I received my license back in 1991, graduated from the University of Southern California with my BS in Business Administration. And again, have my Series 3 Commodities, Futures, and Options license, as well as a Series 65. That's for investment advisors as well. I did have a Series 6 and I'm losing track, 63, I think it's a 63, mutual funds and so forth when I started out in the securities industry, as well as annuities and so forth. But anyway, just to jump in, this is what we don't do. We are not going to give you some sort of approach or method or software with arrows that tell you when to sell and when to buy. We're not trying to day trade what we call the chop in individual stocks. So this is not what we do. And the reason why is because, quite frankly, I think it's too difficult. And a lot of studies out there about day trading and success rates, and of course, they're all over the map, but I think we can all agree that it's really not that easy, or else, of course, everyone would be doing it, as the saying goes. Here's a couple studies. Here's one out of Charles Schwab, a 6-year period of time. Active traders underperformed a simple low-cost index fund, and the most active had the worst returns. Here's a 15-year study out of Taiwan. Less than 1% of day traders consistently beat the market. 80% lost money, and so forth. So, you know, here's an example, not to pick on this guy, but look at this guy, 25 years old. He made $1.5 million during the pandemic stock market boom. Then he lost it all. Now he works at a deli in Las Vegas. So I'm not trying to demean him in any way. The point is that when you're in an environment where you can profit to such a degree, there's also an associated risk with it. So as the phrase goes, easy come, easy go. And we're going to avoid that dynamic, and we're going to show you how we do it here, at least give you a preview of what we're talking about. And, why is it? What makes it so difficult? And this whole presentation for these few days here with David and Timing Research has been about trading discipline and emotions and psychology. And after working with multiple thousands and thousands and thousands of clients over the years, I mean, there's a lot of commonality. And I think these top 3 barriers is what we've sort of really boiled it down to. That seems to be found or seems to be shared by really anyone who's trading or anything to do with money, really. Too much noise, too much information. And I think this graphic summarizes it here. And in fact, the prior presenter talked about ignoring 99% of the news and the media, and that's absolutely correct. In fact, you might even ignore 100% of it in terms of trading. It's not going to help you. Having CNBC and Fox and Bloomberg or whatever on TV, it's not going to help you one bit in the long run. I can tell you that. This kind of made me laugh. How about these price predictions that you get from all these pundits in the media? This one here, he predicts Bitcoin will reach 250,000 next year. And meanwhile, this other prediction here is it could also plunge to 5,000. So basically, they're giving you a range of $250,000 to $5,000. And how on earth is that helpful? I don't know. I mean, why even bother saying it? It's just absurd. And yeah, I'll pick on Jim Cramer. Everyone knows him. We all know his call about Bear Stearns. Nothing to worry about. Don't remove your money from Bear. And of course, it's non-existent anymore. Same thing with First Republic Bank more recently. So really, these people don't know really any more than you, even though they talk a good game. And I shouldn't say they don't know more. They may have a lot of information, but how do you apply it? How do you execute it? That's really the key. So they're really in the business of selling stories, narrative trading, and generating clicks and advertising dollars. Let's be honest, that's what they're in the business of doing. So we're not into that at all. We're not into narratives and storytelling. We think we have a better way. We'll show you in just a second here, at least a preview. And the second barrier here would be, how about just time? Do you have the discipline to screen watch all day? Because if you're going to be short-term trading, even even some sort of investing for the longer run takes some attention, more so than what most people want to apply. Do you want to sit and watch that screen all day, or do you even have the time to do it? We all have other things to do. Just pulled this off the web somewhere. This guy says, I trade full time. I sit in front of my computer from the market open until the market closes, and I watch my positions. Every once in a while, I'm even trading after the market hours. So I would rather be doing something like this. So I think that's a difficult thing to ask people to do. And the third barrier is really just us. We become our own worst enemy with our emotions. How do we master the fear and the greed that are associated with money? So how do you control those emotions? I believe that's out of a Harry Potter movie, which I've never seen. So anyway, you have this roller coaster of emotions here. And just a second, you have your euphoric when things are going well. You wave that white flag of capitulation and surrender when you've had enough pain, and then you start on that cycle again. So remember, you want to avoid that roller coaster of emotions, and keep in mind, you're not really necessarily trading. Your competition isn't other people like yourself at their screen. It's this. This is the competition. Automation, AI, machine-driven, you name it, algos, no emotion, automation, built-in controls. JP Morgan estimates that 90% of US equity trading volume is dominated by machines now. So with that said, we'll look at some option strategies, and in particular, professional option strategies. We'll make a distinction here between professional and non-professional strategies. And the key thing here is that the pros are not option buyers. They don't just buy a call and hope the market goes to the moon. That's not what they're doing. So if you only buy stock options, remember that time is always working against you, or that's called theta, or theta decay. Every option has limited life. So this link here, you look for this on YouTube. That's where I found it. It's from last year, but I kept it because it's very relevant. This is a reporter, I believe, with Bloomberg or CNBC, I can't remember. And what she says here is actually very accurate. The appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. So essentially what she's saying here is anyone can go out and spend a few $100s on some options, but you're really essentially buying a lottery ticket. That's what she's referring to. Now, if you want to trade like a professional, you need to get involved with selling options. That's what professionals are doing, and they trade option spreads. So before we jump into a short example, let's look at an insurance company, and if they were trading options, what might that look like? Well, it kind of looks like the business they're in, really. I think they would do it the way that professionals trade options and the way they trade right now, or at least the way they operate their business, which means they would want to get paid premiums to assume risk, and they'd be selling and managing the time during the duration of that trade, or let's say the existence of the policy, so to speak. And they would always insure themselves against an outlier event or a disaster, meaning they hedge their business. And being in business, they treat it like a business, and they are going to be process driven. They're going to use consistency in their approach and be very patient. And they're by and large looking at math and probabilities and just favorable long-term mathematical situations. And part of that is just with selling options when you have the higher probability outcomes on your side. Now, we're going to look at this real quickly, and don't worry about all the details right yet. We're going to jump into that again in the bigger presentation. But these are called credit spreads, where you're selling option spreads and you're collecting net premium and putting money in your pocket. And we're doing this on stock index futures options. And there are specific reasons why. But generally speaking, that's where all the volume is. And if you didn't know that, we'll spend a little more time on it later, but that's where the volume is. And here's an example of a trade. We created this strategy. It's proprietary to us. And here's the call side of the trade. Here's the put side of the trade. So this is your upper boundary and your lower boundary. And when you place the trade, the market was here, just above 4,200 on the S&P. And for this to be profitable, you want the S&P to stay in a range between the upper and lower boundary. And you can see it did so. And you have a really wide range or margin of error on this position. So that's what we like, higher probability outcomes. But you need discipline, you need a process, you need automation, you need some help in putting this all together. And that's what we've come up with. We have an answer for you with our pre-built or an algo-driven option spreads, proprietary to us. And we have these professional style strategies like the one you just looked at, and then others as well, available through these pre-built strategies. And again, these strategies can be tweaked, built, created, whatever word you want to use for any market condition. Bullish, bearish, or even what we call non-directional or flat markets. And then we use automation. So you don't have to sit in front of the screen. Basically, the software will do that for you, and it monitors and tracks your risk and your profit. And you're going to be out of that trade according to the automation. So you do not have to sweat over when to get out of that trade. Then we also have trade alerts that come along with this. And these are what we call one-touch responsive trade alerts. Just a screenshot of an example. You'll receive an alert on your phone or email, and you can respond with just by touching the screen. And you don't have to log into some other software or try to copy an order. It's all done for you. And we do all of that work with our technology for you. You simply touch accept or reject, and then our technology handles that for you. And again, when I talk about strategies for any market condition, and I'm not going to be kind of a doom and gloomer here, but I think we're probably in for a period that is going to look dramatically different than the last 12 years, for example. As you know, the Fed had money at essentially 0% since 2009, and that's what fueled the asset prices in the bull markets and across basically almost every asset class. But that's not the case anymore, folks. That ride is over with. And part of the problem is the environment we're facing now into the very immediate and near, and even for perhaps the next 10 years. And I'll show you a little bit more about that. It's really swimming upstream. And part of the problem is inflation. And you think, well, I might be getting a raise, but inflation is outrunning wage growth. This poor guy says, well, he thinks his head is still barely above water as the wages sink in relation to inflation. But this is really accurate here. Ron Barron, he's an investor, some billionaire. And he points out that long-term inflation is closer to 4 to 5% a year. It's not 2%, which is the target from the Federal Reserve, because everything doubles in price every 14 or 15 years. And he's absolutely right. Inflation is really eating away at your purchasing power and the value of your dollar. And here's the target for inflation, 2%, and we're still right around 6%. So we have a long ways to go. The IMF cut its global GDP outlook, warns of heavy downside risk, a risk of a harder landing. That's just a few weeks ago. This is interesting here. Morgan Stanley points out every hiking cycle over the last 70 years ends in recession or a financial crisis. Well, you saw what happened to the what's it called? First Republic. That's right. And there is a crisis. It's not going away yet. It gets quiet for a week or two, and someone like Jamie Dimon at JPM gets all the assets and just gets more powerful. But there's a lot more banks to follow, in my opinion. Here's the manufacturing data. Just the sixth consecutive month that the headline number is in traction territory below 50. So you have economic decline, but at the same time, you have the prices paid component here is moving higher. So you have an inflationary component. So that's called deflation. So we're in a real tough spot here, folks, economically. Leading economic indicator index is signaling recession over the next 12 months. You can see here these gray areas with the red bar. That's your recession signal. Another one here. You can see here in 2020 with the pandemic, of course, and now we're getting another signal. So we're probably, well, we are already in recession. And look at this, $300 million office tower in San Francisco might sell for 80% less. So it'll sell for maybe $30 million. And that's happening all over. It's happening in Los Angeles, Orange County that I'm aware of. Big, huge price cuts on commercial real estate as well. And look at the stock market. 30% of the gains in the S&P 500 this year are due to one stock, Apple. And you probably sort of knew that, but when you think about it, it's kind of crazy. This huge index, 500 stocks, and 30% of those gains are attributed to just one stock. Then how about all of the gains in the S&P 500 are due only to, you guessed it, a handful of stocks. The top 8 stocks are contributing more than all of the gains in the year-to-date gains. So you can see this graph, I'll explain it. The black line here is the S&P 500. And then you see this kind of brick color here. That's the contribution from the 8 FANG stocks, plus Microsoft and NVIDIA. So you can see the contribution of the 8 stocks makes up the entire positive return year to date on the S&P. So that is not a sign of a healthy market. There's a lot of dysfunction going on for sure. So we like what we do with the options and the alternative approach, where you can use these strategies for any condition and you can adapt them to your situation and your outlook. These are called non-correlated investments or absolute return instruments or strategies. Now, here's an example of why you want to try to avoid these big market drawdowns. You can see these red sections here looking back in time, where the market, the S&P 500, went negative, went over, well, almost 50% negative in 2008, if you recall. And looking at the graph, you think, oh, well, all you had to do is nothing and just sit on it, or maybe buy more and it's going to come back. Well, even so, it still took 6 years to get back to even. And even in 2000, I think it took another, 8 years to get back to where you started. And if you look back further in time, there are many periods of, 10, 20 years or longer where the market doesn't recover. So a quick recovery is not an assured thing. And here's Stanley Druckenmiller. If you don't know who he is, I'll tell you in just a second. But he says there's a high probability the stock market will be flat for an entire decade. And let me show you here. It says here, given his track record, you would be wise to heed his warnings. So exactly who is he? Well, he's a hedge fund manager. And if you don't know, he had an average annual return of 30% from 1986 to 2010. I mean, an absolutely unprecedented track record. And the key thing beyond that amazing track record is, I believe he had only 1 year with a very, very small loss, a small drawdown. So he's generating 30% a year with hardly any drawdowns, and that is just really unbelievable. So I think we should pay attention to the people who have a history of success and performance. And that's why I threw him in there. So I think we should kind of heed that warning. Looking out into the next 10 years, it's not going to be a landscape where you can just passively buy and hang on to something. So we don't think portfolio 1 is a good idea. That's our opinion. Or 2, I think last year, actually, the 60/40 portfolio did worse than just being in stocks in general, which is kind of crazy, but that's how these things happen. So the alternatives pie there, having a portion of your portfolio in alternatives makes a lot of sense, which is, of course, what we do with our option strategies. And I'd like to invite you to sign up. Here is the link, TimingResearch.com/AltaVest. And we're going to have a big presentation June 1st at 7 p.m. Eastern. And we're going to do a full live demo of our trading solution with these professional option strategies, show you how to look at these approaches for any market condition, automated premium collection, automated risk and profit management with our integrated one-touch trade alerts that we saw just an image of there. You just touch, accept, or reject. And we also offer personal coaching. That's part of what we do as well with our client base. So this is what the landing page looks like. So if you go ahead and you can just take a screenshot of that page or take a picture of it, so you make sure you have that URL, that sign up page. I'd love to have you there and answer a lot more questions and talk with you a bit longer. And when we dive in and take a much deeper look. So let's see here. I see the link right there. And yep, that's the correct link. So I think that is the, I guess you call it a sneak peek preview. That's a tongue twister of what's ahead here on our really, really big presentation coming up. Again, June 1st, Thursday, 7 p.m. Eastern. So I'd love to see you there. Feel free to register right away, save your spot, reserve your seat. We had a big turnout last time we did this, so want to make sure you get on board. And if anyone has any questions while you've got me here, that's fine, but I know I didn't go too deep, so there may not be any questions. And but save those questions for next time when we get into the live demonstration. We'll go through the software and all the simulations. We can do back testing, we can do automation, and we can make this option spread trading something very, very accessible and user-friendly for you. And I'm excited to show you about it. So I look forward to seeing you June 1st. And thanks for joining me. I think that's all I have at the moment.